Hello, welcome to this webinar on business valuation and maximizing the value of your business. Part one will focus on the valuation side. Part two focuses on the maximizing the value of your business. My name is Stephen Beal and I'm the principal of Beal Business Brokers and Advisors. We help people buy, sell, value, and improve their business. So today's agenda is the basics of business valuation, what you need to know in terms of how people look at the value of your business. And then, as I said, more in part two, we'll get into how do you enhance the value of your business. So an interesting stat from Statistics Canada is that on average, owners spend 20% more time working on their business than any of their employees do. However, on average, owners earn 20% less than their employees do. So your average employee earns 20% more than your average business owner, and yet business owners are spending 20% more time working on their business. So if there's any group in our society that can claim that they are overworked and underpaid, it's business owners. And I tied this into business valuation because it's important to understand. One of the key elements when we do a business valuation is to say, well, how much does the owner pay himself? And is that fair market? Is he underpaying himself? Like a business could be profitable, but only because the owner pays himself minimum wage. So you can take any business, make it profitable because by forcing the owner to take less than what he should pay him or herself. So what are the times when a business valuation is important? So one is if you're about to invest more of your own money, it might be useful to know that your business is valuable and worth taking more of your own money. Certainly, if you're looking to raise external financing, if you've ever watched Dragon's Den or any of those shows, they always want to know, well, what's the value of your business? What's your ask? What percentage of your business are you going to give us for X dollars? So certainly, if you're looking to raise external financing, it's important to know the value of your business. So back to point number one. Before you invest more of your own money, perhaps it's useful to know what is your business worth. Maybe you want to plan ahead. So if you're thinking of selling your business in 5 or 10 or 15 years, it's useful to know what's your business worth now and how do you get it to the next level. Perhaps when you're looking to buy another business. So if the bank is going to look at your current business and the business you're going to buy in order to finance it, it's useful to know how much your current business is worth. Certainly an exit strategy. Are you financially able to retire? If you're looking to sell your business and that's going to finance your retirement, what is that number and how close are you to it? And certainly if you're going to negotiate with the buyer, it's useful to know what's my business worth. Also, as tax planning, your business will, CRA will want a piece of your business when it's sold or a piece of the proceeds. So it's useful to know how big will that number be. And finally, in divorce situations, we get called in when a husband and wife are separating or divorcing and they need to split the matrimonial assets. And if a business is part of it, they need to know what is that number. With valuation, generally there's 3 methods that we look at, 3 broad methods. One is sort of asset-based, and probably the simplest way of thinking this is we focus on the balance sheet. So what do the assets and the liabilities tell us about the value of the business? The second is market-based. So what do similar types of businesses sell for in this market? If you think of selling sort of residential real estate, it would be more or less a market-based type of approach. What do similar houses sell for in this neighborhood? So that would drive the decision or drive the numbers. And finally, and probably the most popular, the most one that people look at most often when we're looking at operating businesses, is the earnings and the cash flow or the income statement driven valuation. Now, all 3 of these are useful approaches to valuation, and we look at all 3 every valuation we do, we look at all three aspects to understand the business, but we typically pick one of the three. The footnote there is that all three are useful, but not additive. So we don't look at the cash flow of the business and say it's worth $10 million based on cash flow. Oh, but there's $5 million worth of assets, therefore the number is not 15. It's the higher of those two numbers. So it's important to understand that. We can't, if you need $5 million worth of assets to generate enough cash flow that is worth $10 million on a cash flow valuation, those assets are required to generate that income. And so essentially you'd be double counting if you took the asset number and added it to the income statement number. Having said that, there are certain situations where there are parts of the balance sheet that you do add in or deduct, for that matter, after the fact. So if we are focusing primarily on the income statement or the earnings or cash flow method, then valuation becomes a function of two main issues. So essentially, the earnings or the cash flow is multiplied by a factor. People also talk about discount rates or cap rates or whatever. I don't want to confuse the issue, but essentially one discount rate is just the inverse of a factor. So if I tell you that this business sells for a multiple of 5, then essentially the implied discount rate or cap rate that I'm using is 20%. It's the inverse of a 5 times multiple. I'll try and avoid too much math in this. The other concept to understand, so we talked about the multiple, we talked about the earnings. As we look at the earnings, there's two different concepts that we look at. Certainly, if we're talking about publicly traded companies, the earnings number they always talk about is earnings after tax, and typically it's a per share number. So XYZ Corp made $5 per share, and that number is always expressed after tax, and that's how the convention for public companies. And so when we get into a discussion on multiples for public companies can be quite high. Certainly some public companies like Amazon or Tesla or whatever can be ridiculously high. Just a disclaimer, I'm not giving investment advice here, but your average blue chip company, say Bell Canada or RBC, traded on the stock exchange, typically the earnings after tax multiple is around 15. We don't see that level of multiples with most private companies because for a number of different reasons that we'll get into. But one of the key ones is when we're looking at private companies, we're typically looking at a pre-tax number. We're also looking at what is referred to as EBITDA, or earnings before interest, taxes, depreciation, and amortization. And then we normalize perks to owner. So that's part of what we look at when we're looking at a private company and we're talking about EBITDA. EBITDA is essentially the cash flow available to a manager or to an owner who is not the manager. For even smaller companies, so these are companies that are typically owner operated. So a 5 or a 10 person firm that is going to be owned and run by the same individual. We'll typically look at another definition of cash flow or earnings that we refer to as discretionary earnings. And that includes all the things we talked about with EBITDA plus the reasonable owner's compensation. So whatever the owner has paid himself, we add that back. So if I can use a numeric example, these are the types of things that we look at. So if we start with the pre-tax profit, in this simple example, 300,000, depreciation is 25,000, interest expense on the loan is 40,000, the owner's excess salary. So as part of getting to a normalized EBITDA, we would add back what the difference between what the owner pays him or herself versus what he would need to pay a manager to run his business. We'd also add back any perks, like say travel or cell phones or auto expenses that are unrelated to the business. If he has a vehicle and he's visiting clients all the time and it's 100% business use, then that is a business expense that we wouldn't adjust. But in this example, we're going to say that there's 15,000 of perks. So that gives us a normalized EBITDA of 480,000 in this simple example. If we go the next step, we're going to talk about the owner's base salary. So the amount that we left in when we adjusted his excess salary. So in this case, we're saying it's 70,000. So that's his base salary, or that's what we've determined he would have had to pay a manager to run this business for him. So in that case, his business discretionary cash flow is 550,000. So if those are the issues that we look at when we look at the income, the next step is what multiple do we use? How do we take these numbers and determine business value by applying a multiple to these numbers? So the multiple is impacted by risk. So essentially the risk is impacted by overall interest rates in the economy. Nowadays, we've had historically low rates for so long. The rates moving 10 or 20 basis points, as much as it might scare the stock market, don't really impact transactions in private companies. What's much more influential are industry risk and qualitative factors. And so the qualitative factors are quite numerous. And they range range from customers, employees, the leases, the growth of the firm, how fast is the business growing, how volatile is the business, how competitive is the business, location is important, how much time does it take for the owner to run the business, things like intangible assets. So certainly intellectual property or patents or trademarks or software, all those different things come into it. All of these things are qualitative factors that impact what the final multiple might be. So as I mentioned earlier, public companies typically, again, we're talking blue chip, solid public companies that aren't IT related, will typically trade with multiples of 10 to 20 times. So your standard blue chip bank might trade at 15 times. But again, these numbers are based on after-tax earnings, so that in and of itself gives the multiple a bump. Private companies are typically multiples of 2 to 5. And yes, every so often we will see multiples of 6 to 7 or 8 for a private company, but that's less common. So other reasons for public companies getting a higher multiple, they're professionally managed. So there's a management in place. Typically, any publicly traded company would have layers of management. So they're larger. That typically means safer than a small company. And finally, they're much more liquid. You can sell your shares in the Royal Bank of Canada in 2 seconds on your cell phone. If you're trying to sell a private company, it will take you 3 to 6 to 9 months. So that in and of itself reduces the value of the shares of a private company. And if you're a minority shareholder in a private company, you're going to have an even further discount because you have no control over that private company. So a bit more detail on the multiples. So as I mentioned, the multiple ranges are typically 3 to 5 for EBIT or EBITDA. Again, sometimes you might get 6 or 7 for a private company. discretionary earnings, and people always want to debate discretionary earnings, saying, well, but the owner manager deserves an income, so you shouldn't add that back. You have to deduct the salary paid to an owner to determine value. And I don't disagree. The issue is where it comes out is if we're going to use discretionary earnings as our definition of income, then the multiple is lower. So that is typically how it's counted for. The advantage of using this is as we're pricing businesses, the databases that we have are we typically have discretionary earnings as the variable on the business, and it's less common to get EBIT or EBITDA, or at least a clean EBIT or EBITDA from some of the databases that we use. But certainly it's a lower multiple. If we're using a higher definition, the higher definition of income, then obviously the lower the multiple needs to be. And then note the thing at the bottom there, other adjustments may also apply, such as working capital and fixed assets. And what I mean by that is, these multiples may apply, but sometimes there's a working capital adjustment, typically if there's a lot of inventory or a lot of receivables. As I mentioned earlier, valuation is not additive. And here's a simple example. If you have a business, it's bottom line, its EBITDA is 500,000. Let's say our multiple is 3 to 5 times. So that suggests the value of the business is somewhere between 1.5 to 2.5 million. So that would include all the normal operating assets. So we don't add them on top. So whatever inventory you need to run that business, whatever equipment you need to run that business, it would be included in that $1.5 to $2.5 million value. Exceptions may include things like real estate. Real estate is typically treated outside the sort of EBITDA framework, or certainly surplus land or any other surplus assets or inventory. So if the business has $2 million in inventory, but it really only needs $1 million, then that's probably an adjustment that we'd need to make. To sum up sort of the valuation metric, there's this box of reality that was formulated by a business broker in the States. And it's a simple way of looking at a business. A business should be able to afford a salary to the owner if working full-time. It should be able to pay off reasonable acquisition debt. That doesn't mean that if you buy a business for $1 down, it can pay off the millions of dollars of debt that you've just put on. So it should be able to pay off reasonable acquisition debt on a structured transaction. It should be able to pay for new capital investments as required, and it should be able to finance some growth in working capital as the business grows over time. That's the end of phase one. That's the end of part one of business valuations. In part two, we will explore a bit more detail on all the different variables that go into the multiple and how to enhance the business value by addressing some of those things. But no webinar would be complete without a quick summary of what we do and a sales pitch. So we help people determine business value. We do this for the issues that we discuss, whether it's tax planning or the sale of your business or preparing to buy a business, all the different scenarios where you'd need to know what is the value of a business. So we assist in that. We also assist in helping people buy a business. Obviously, we're business brokers, so obviously we'll help you buy any of the businesses we are currently representing. Or if you found a business on your own and you want a second opinion as to what it's worth and how to help through the process, we help people with that in terms of structuring the deal. We help in selling businesses and mergers and acquisitions, so we can assist you in that. We also help in family transitions. If you're looking to sell your business to your kids, we help with that. One of the key elements is, what is it worth? And CRA has a keen interest in making sure you sell it to your kids for the full value of the business. We also help in management transition. So if you're going to sell to your management team, what's the business worth? What's the best way of structuring it? We also assist with business plans, with financing, and with strategic plans. Thank you for listening, and feel free to contact me if you have any questions. I can reach by email or through our website. Thank you very much.